Thanks, Rabia. So a little bit of background on me. I actually graduated from the full-time MBA program in 2009, which was a very interesting time to graduate with your MBA, and actually ended up working in the luxury industry largely, I think, as a result of kind of the time that I graduated. I had a full-time offer in consulting at a strategy firm. It ended up getting pushed back till January because of all of the hiring freezes that were occurring at that point, and ended up teaming up with Professor Galloway, who you'll hear from later today, on a startup called L2 that looks at one of the, I think, the seminal changes that's happened in the luxury industry over the course of the last 5 years, which has been them really opening up to digital innovation. And the presentation I'm going to go through today is really going to look at what the luxury business looked like in 2009 when we first started looking at it, and what the business looks like today, because there's been a huge shift in terms of how companies have emerged from the recession, and there's a lot of trends and changes, which I think when you're looking at luxury through the business angle, through the creative angle, and as people who are either in the field or looking to go into the field, I think really impact how you look at the industry. So this is how kind of my entrance into the luxury industry started. In 2009, we did a ranking of 109 luxury brands across several categories, ranging from automobile to fashion to beauty to hospitality, looking at their digital competence. And at that point, digital and luxury were two things that didn't necessarily mix all that well. Digital was thought of as very democratized, luxury thought of as very exclusive, and the thought of selling luxury brands online was just, the industry was kind of just starting to wake up to that. And then there was this big thing called Facebook, which really was a big challenge for brands like Chanel and Louis Vuitton and Estee Lauder, who had never necessarily had that direct relationship with their end consumer. The nice thing about recessions is that when businesses go into decline, it really forces them to rethink their strategies and to start doing something different. And the luxury industry had come off of, prior to 2008, some of the most successful years in business history. A lot of the consolidation across firms like LVMH, PPR Group, which is now Kering, Estee Lauder had made several acquisitions, and the business was really on fire. And then it sort of hit a stall point in 2008 with the recession, and really forced them to try some different things. And one of those things was digital. So the brand that really kind of started it all, so this is looking at our initial ranking back in 2009. And what's interesting here is that Burberry, and for any of you that are aware of sort of digital innovation in luxury, Burberry's kind of written the book on digital innovation. And back in 2009, they were kind of in the middle of the pack. Now, in 2009, to be a genius brand like Louis Vuitton, you had a basic website, you were translating your assets into some form of digital form, you were starting to engage with your consumers on Facebook, had kind of a small, tiny e-commerce business that was kind of an afterthought. Nobody was really doing anything. And then what happened is in November of 2009, Burberry launched a site called Art of the Trench. And Art of the Trench incorporated user-generated content of people wearing trench coats, which was inconceivable kind of at the time, is that you could create these experiences with real people, not models, do it in a digital way, and really engage consumers. And I think what happened when this site came out was that the industry kind of woke up to the possibility of really creative collaboration in this space. Now, Burberry made huge investments following Art of the Trench in things like Facebook acquisition. They quickly climbed to 1 million, 2 million. Now they're at about 16 million likes on Facebook. But what's interesting is you're starting to see this second wave of digital innovation. Burberry has actually steadily, this is looking at the average likes on Facebook that brands have added across the luxury space by quarter. And Burberry, who is really the poster child for this fan acquisition growth on Facebook, has slowly pulled back. And where Burberry has shifted their strategy, which is where you're starting to see kind of as organizations enter the second inning of innovation, has been into things like the use of customer data, fulfillment, CRM activities. And you're starting to see the next wave of digital innovation in this sector really be about how do you create that one-to-one relationship with the consumer. Now, at the same time, and I think this really symbolizes the egos in the industry, Bernard Arnault over at LVMH said, Louis Vuitton and Dior, you better get in the game and get up to those Facebook fan counts of Burberry. And they've spent a lot more money on Facebook advertising to get up to the point where Burberry is, around 16 million likes. Now, Burberry has also done some interesting things, as they've really been one of the financial success stories of this industry. In 2012, they purchased back their license from Interparfums, really taking control of their business from a vertical perspective and allowing them to launch into beauty. One of the things they did in 2010 was actually buy back their Chinese franchises, again, to take more creative control and ownership control of the business globally. And if you've kind of watched what's happened with the Burberry story, they've slowly kind of scaled back the traditional plaid SKUs and have gone to much more sort of lifestyle fashion that's a little bit less branded. What's also happened, and this has been a huge trend across luxury that continues to exist, is that they've moved from a large mix of a wholesale and a retail business to a largely retail model where they're controlling distribution end to end. So in 2009, 41% of their business was done through department stores and other wholesale channels. If you shift forward to 2013, that number is at about 24%. And there's been a lot of verticalization, not just with Burberry, but from a lot of the financial success stories in this industry that didn't exist kind of historically. The most recent shift, which was, I think, one of the more interesting kind of plays around democratization in luxury, is for all of the control that Burberry's tried to take back. Burberry actually went live on Amazon to talk about kind of the big shift that's occurred. In 2009, you had brands that were hesitant to even sell online. Now you have luxury brands that are selling in the world's biggest marketplace. And Amazon, 3 of the initial partners with Amazon Luxury Beauty, Burberry was actually one of them. Now, some of this was to control some of the gray market distribution that was happening on the platform. But it's also that the volumes and the allure of a platform like Amazon were just too much to resist for the Burberry brand. Number 2, the icon. This was an advertisement that was done back in 2009 by Louis Vuitton. And if you look at kind of this advertisement, it's looking at Sally Ride, Buzz Aldrin, really kind of their core equity around travel and journeys. You see several of their branded bags kind of prominently featured in that advertisement. Beautiful imagery. They did a fantastic job of translating this across mediums. If you flash forward to Louis Vuitton's advertising today, this is Fan Bingbing out of China, who's probably one of the world's most popular celebrities and is going to become even more so when she becomes part of the next Iron Man franchise. This is the Alma bag, which Louis Vuitton launched as their business starts to stall in China because the traditional iconic Louis Vuitton checkered plaid has become too synonymous and too commonplace in China that they've actually experienced some decline in sales and are moving much more towards traditional leather goods. Now, if you look at what's happened across LVMH, and LVMH has largely kind of been the growth driver for the modern luxury business, the luxury business as a whole is a great business to be in right now, up about 20%. Stocks across the sector are up about 20%. LVMH, however, is up just 5%. And what's happened with the LVMH business is that the fashion and leather goods business, really led by that core Louis Vuitton brand, has actually started to stall. Louis Vuitton, now about a $7.1 billion business, and they've started to recognize that there's not a lot of additional pockets for growth. They're up about 3%, fashion and leather goods up 4%, all of LVMH up just 8%, which 8% is a great kind of sales growth number, but when you're looking at the luxury sector, where you see sales growth in the low teens and sometimes 20% range, definitely stalled versus some of their competitors. What's also interesting is when you look at the Louis Vuitton business as part of LVMH versus looking at the Kering business, which also has that big core anchor in Gucci, is that LVMH doesn't have as much of a confident path to look elsewhere for growth. Marc Jacobs, which has been the success story of LVMH, has recently suggested that they're going to go public separately on the public markets. And then they have two kind of smaller little brands, Celine and Fendi, if you can call a $500 million business little, that don't necessarily provide the core anchor as what you see across Kering. Now, if you look at Kering, they have the support of Bottega Veneta and Saint Laurent, and also the Gucci business hasn't quite yet reached scale. So you have some kind of shifting tides in terms of these luxury conglomerates. And then most recently, I think signaling kind of some of the shift in these businesses. This is looking at a similarly large player to Amazon, Taobao.com, which is the largest e-commerce engine across China. Louis Vuitton recently became the first luxury brand to actually come to an agreement with Taobao to clean up all of the gray market distribution on the platform, which is the first step in terms of the LVMH portfolio beginning to distribute on China's largest e-commerce platform. Number 3 is the dark horse. And when we look at this through an innovation perspective, Richemont, which is a conglomerate of primarily watches and fine jewelry items, in 2007, their CEO and chairman said publicly that their brands would never be on the internet. They said the internet was a cesspool. We are not going to go there. If you look at what's happened, so this is looking at the channel shift that's occurred across the business. Now, in 2010, Richemont acquired Net-a-Porter, which is the world's, I think, most preeminent luxury online destination and is an e-commerce only player. So he kind of had to eat his words a little bit. But you've also seen this shift, similar to what we saw with Burberry, around much more verticalization. And now the watch category specifically has been dominated by mom and pop players that are highly fragmented. As Richemont looks for new pockets of growth, particularly in Asia and other markets, they've really moved to much more of a store concept. And they launched 66 new stores in 2012, have another 50 planned for this year. And in 2011, after that acquisition of Net-a-Porter, reached a critical benchmark where more than half of their sales were done direct to consumer. When you look at what's happened across e-commerce, specifically, in 2010, just 29% of watches and jewelry brands were selling online. I think watches and jewelry has been one of the slowest industries to embrace the internet, largely led by gray market off-price product, sites like Joma Shop, which are selling things for 20, 30, 40% off MSRP. Shift forward to 2013, and for the first time, more than half of brands are now selling direct to consumer through their sites. Now, who's led this penetration? It's largely been Richemont. And when you look at their brands, now 8 of Richemont's 11 large watch brands sell online. They're selling items up to $90,000 that you can purchase through the site without even making a phone call. And it's really led a shift in terms of how the industry has kind of approached these businesses. One of the things that we like to look at when we're analyzing organizations is how do these new luxury enterprises start to add value across a house of brands. And what you see here, this is looking at the average digital performance across some of these big groups. Richemont has an average IQ of 112, which is substantially higher than the next largest watch conglomerate, because they've made shared services investments in things like CRM, in a common e-commerce platform, and have really started to institutionalize enterprise performance. Number 4 is the new kids. There have been several kind of emerging players in luxury over the course of the last 5 years that have really built their businesses in a non-traditional way. If you look at Kate Spade, Tory Burch, and Michael Kors in 2009, all kind of between $100 and $400 million businesses. Flash forward to 2012, Kate Spade now just under $500 million, Tory Burch estimated at about 800 million. Michael Kors was at 1.3 billion at the end of 2012. Their latest revenue estimates for 2013 is that it'll be a $2.2 billion year for Michael Kors. So the growth across these brands, upwards of 200% in every case. However, the path that they've taken, so the traditional path for luxury brands has been print advertising, it's been theater retail, and it's been a smaller kind of wholesale business. For these guys, it's been e-commerce, it's been digital programming, and it's really been this halo of innovation around their products. This is looking at the path specifically for Tory Burch from 2009 to 2012. They've grown their e-commerce revenues from 30 million in 2009 to 117 million today. What's interesting is that 117 million accounts for 17% of their overall sales, but 30% of the profitability of the business, and has funded Tory Burch's international growth and probably one of the hottest kind of private companies in fashion right now. Kate Spade, a little bit more tactical, but has seen their path also around e-commerce. They've used Facebook as an acquisition tool. They run surprise sales for 75% off. They run some Facebook advertising where they can acquire names at about 50 cents. And then they get that email address, opt that consumer into ongoing e-commerce marketing, and 20% of the Kate Spade business is now driven online. That business is actually bigger than their overall store business in the US. Also has experimented with new channels in luxury, a continued kind of vertical retail presence, actually selling exclusively on Facebook. And then this is looking at their pop-up shops for the new Kate Spade Saturday program, which they launched recently, the Kate Spade Saturday brand, which they launched recently, with which a click of the button on a kiosk in New York, you could actually receive a product within 2 hours anywhere in the city. Michael Kors has been on a path around media spend. So this is looking at that impressive growth trajectory. So as they grew from a $400 million business to a $1.3 billion business, the size of the bubble there is looking at the size of their overall traditional media spend. And what you can see is as it steadily goes down, the percentage of their overall sales that they're spending on above-the-line media starts decreasing significantly. And actually, that bubble shrinks versus grows, which is a very interesting phenomenon when you're talking about aggressive growth. The percentages there are looking at their operating margins. So through that impressive kind of growth trajectory, they've expanded their operating margins from 6.1% to 19%, while investing substantially less in some of the traditional broadcast channels. Where has Michael Kors invested? They've invested in content on social media platforms. They've leveraged Michael Kors as a celebrity on Twitter and other platforms, and have really kind of, I think, developed the next generation strategy for luxury brands. And then where are all three of these guys going? Into beauty. And I think beauty has been the way a lot of these businesses really begin to start monetizing that brand halo that they build. Which leads us to the final shift and looking at the arms race that's occurred. Probably the best business to be in luxury coming out of the recession has been the beauty business. This is looking at the shift that's happened across personal care. If you look pre-recession, the growth in the personal care category was largely driven by commoditized product categories. As big CPG companies expanded and took advantage of increasing pockets of wealth in emerging markets, they were able to drive substantial growth. Coming out of the recession in 2009, you see much higher growth numbers around the beauty side of the business, and particularly premium cosmetics. The channel strategy has shifted fundamentally as well. When you look at the traditional channels around beauty, it's been department stores, it's been specialty retailers like Sephora. If you look at those businesses in 2008, effectively all of them were booming. If you look in 2012, the majority of traditional channels in beauty are flat or are in structural decline, and you have e-commerce up 20.4%. Now, what's happened over this same period of time has been interesting because not everything is all digital all the time. This is looking at Estee Lauder, who historically had never advertised on television with the exception of some of its fragrance brands. And while they've really dialed up the digital elements of their business, they've also aggressively increased their television spend. They see the marriage of the two, that traditional television, which drives awareness, with a strong digital presence has really been kind of the recipe for success. And then similarly across print, the cosmetics business is really kind of keeping the lights on at places like Condé Nast and Hearst right now, up about 14.2%. If you look at virtually every other category, they've decreased their spend dramatically on magazines. Some of this is because the print publications are offering better added value. A lot of this is because of muscle memory and the business is on fire, so they tend to invest more in some of these traditional channels. This is just looking then at the overall stock performance of the beauty sector. The purple bar here that's flat is looking at the S&P 500. And there you see the performance of Revlon, Elizabeth Arden, L'Oreal, and Estee Lauder up substantially over the S&P. And finally, a closing thought. This is looking at the financial growth across some of the major performers in the luxury sector since 2009. And again, kind of turning to this theme of recession. And if you look at kind of what the recession forced companies to do, it effectively forced them to kind of trim the fat, to clean up their operations, to cut the costs out of the system. And what has emerged is as the business has rebounded, if you look at the overall sales growth across these companies, it's been astounding. They've tapped into new markets, largely out of APAC, as well as other emerging markets. They've seen healthy growth in mature markets, such as the US and Europe. And you see sales growth across Estee Lauder up about 39%, now for the first time a $10 billion company, and with brands like Michael Kors up 449%. But when you look at the profitability growth across these companies, it's been staggering. And that's largely been, I think, because of the recessionary elements have been incredibly good for their business. And also tapping into some of these new channels has really, I think, revolutionized how kind of luxury is going to look moving forward. Thank you for your time.